The sharp falls and increased volatility in markets in August continued through September and resulted in the weakest quarter for markets since the Euro crisis of 2011. A fall of 3.7% in the MSCI World Index in September took the returns for the quarter to minus 8.4%. From the peak in late May, the index dropped 14% by the end of September. Emerging markets performed much in line with developed markets in September, down about 3%, but fared much worse over the quarter, down 18%, taking the fall since this year's peak in April to 28%. The overriding factor behind these moves has been clear evidence of slowing global growth, especially in emerging markets, which have been at the epicenter of this latest bout of market jitters. Emerging markets have faced the near-perfect storm: sluggish global growth, the challenges of reining in a credit boom, excessive dollar debt exacerbated by a strong dollar, inadequate structural reforms during the boom years, domestic policy mistakes on a grand scale, notably in Brazil, and now the slowdown in China and the related collapse in commodity prices on which so many emerging countries depend. China's modest devaluation of the renminbi was the trigger for the big sell-off in August. Perversely, in September, it was the Fed's decision to keep interest rates on hold that caused the further leg down. While on the surface, the continuation of near-zero interest rates should be positive for markets, it was the Fed's reasons for deferring any rate increase that caused further alarm among investors. By citing concerns about global growth, and in particular in China, the Fed seemed to confirm investors' worst fears that growth was stalling and the risks of a recession increasing. Recent data releases have confirmed the trend of weak and falling growth across the emerging world, with Brazil and Russia in outright recession, and China quite evidently slowing to a much lower growth rate than the 10% plus that we've all become accustomed to in the past decade or more. With emerging markets now accounting for 40% of global GDP, China alone for 15%, a slowdown there now has substantial implications for growth in the developed world. And it's providing a deflationary pulse to a world still struggling to break out of its long period of debt-induced, sluggish activity and low nominal growth. The biggest driver of China's slowdown has been the huge overcapacity in many industrial sectors that's followed the massive fixed asset investment program and misallocation of capital of the past 15-20 years. The cutback in capital spending now underway is a necessary precondition for a successful rebalancing of China's economy towards the consumer and service sectors. But in the meantime, it's caused a big drop in demand for industrial metals. So the most obvious damage from the slowdown in China has been to commodity markets and resource producers, which have suffered a severe bear market this year, perhaps best illustrated by Glencore, one of the world's biggest mining companies. Listed on the stock market, its IPO was at the peak of the commodity boom in 2011 at a price of 530p. Share price collapsed to 68p in late September as investors worried that the equity could be worthless. However, in the first week of October, and here we are on October the 9th, there's been a sudden and sharp reversal of the trends of the past few months, driven in part by a growing belief that the Fed and other big central banks will be forced to keep monetary policy exceptionally loose for a long time ahead, thereby extending this already long credit and market cycle, and in part by aggressive short covering. There's been a sharp recovery in stock markets, led by emerging markets and commodity stocks. In a week, the past week, the MSCI World Index has risen by 7%, recovering half of its losses since the peak in April, while emerging markets are up by over 10%, and many commodity producers by 20 or 30%, in Glencore's case, 100%. The move has also been helped by a recovery in the oil price, up over 25% from its lows, as the first evidence of supply cutbacks begin to filter through, as well as growing concerns surrounding Russia's military intervention in the Syrian crisis. During the sharp falls in equity markets in recent months, there was a few safe havens for investors. Gold was disappointing, slipped by 5% over the quarter, and many parts of the fixed income market suffered from rising credit spreads as falling growth fears raised the spectre of defaults. However, government bonds across the developed world proved their worth as safe havens in times of turmoil, and in the face of rising deflationary concerns, they returned close to 1% in September and 2% over the quarter. A sharp rise in volatility, big falls in equity markets, and a flight to safety all raise alarm bells for the state of the global economy. There are increasing concerns that the world will continue to struggle to produce sustainable growth at a level which will begin to enable the huge debt built up over the past decade or more to be paid down. Deflationary forces, especially those coming from the emerging world, are currently powerful. I think we've entered a particularly difficult and challenging phase of the cycle. But we need to keep the critical issues in perspective. China is on a path to structurally slower growth, but its consumer sector is strong and much more influential on growth both in China and globally. The economy is rebalancing, it's not coming to a shuddering halt. And this will ultimately be a positive development which will create big opportunities for many countries and companies. The collapse in commodity markets causes some dislocation in the early stages of the down cycle and cutbacks to capital spending in important parts of the global economy. But these negative effects will be more than offset by the positive impact of lower prices to users. This is going to provide a boost to real incomes and to spending, and will keep inflation at very low levels for some time ahead. In turn, this enables central banks to maintain very loose monetary policy and continuing stimulus without risking inflation. It's now highly unlikely that the Fed will raise rates this year, and indeed it could be late into next year or even beyond that before the first rate hike finally comes from the Fed. It seems to me that markets have adjusted rapidly to the slower growth in the global economy and have fallen faster than fundamentals in the past few months. Recent economic trends suggest the cycle is going to be extended much further, with continuing low interest rates across the developed world, the near certainty of additional central bank support if growth falters, and the prospect of continuing subdued but sustainable recovery in the US, UK, Europe and Japan. Nowhere across the developed world do we see conditions which would cause a sharp tightening of monetary policy for the foreseeable future, many years ahead. We therefore believe that the worst is over in this latest risk-off period. There are clearly significant imbalances across the world and a high level of uncertainty, not least around the ultimate end game of this long period of extraordinary monetary policy. This will keep volatility at high levels, but for longer-term investors, volatility creates opportunities to add to investments at attractive levels. And we've been using the falls in recent weeks to add to our risk positions in portfolios, especially in equity markets. As we enter the final quarter of the year, there are attractive opportunities at much improved valuation levels across many markets, and we anticipate better returns after a difficult period for investors.